Howdy, folks. Welcome once again to Smarter Money Matters with your wealth doctor, Dr. Jeff Camarda, joined by our super CFPs, Lou Versil and Anna Wunderlich. Thank you so much for watching once again. And today we have some really poignant information on the best ways to do Roth IRA conversions before retirement. Converting IRAs, pre-tax money that hasn't been taxed before, into tax-free Roth accounts. As many of you probably have done or have considered, but there are some elements to consider. Because remember, when you do the Roth conversion, you're basically paying the tax on the pre-tax IRA and sometimes 401ks in order to get it into a tax-free environment. Remember, IRAs are typically, traditional IRAs, all pre-tax money, which means they never tax. When you put the money in, you got a tax deduction. When you take it out, you got to pay the tax on the entire amount you take out. None of it's ever been taxed before. So Roths are really cool because it's tax-free, although it is painful to pay the tax. And these folks, and this is drawn from the Wall Street Journal article, have done another study, which actually drew some interesting conclusions. I view them as somewhat one-dimensional, but we'll get into that at the end. But they modeled the decision of many different tax and market scenarios, running hundreds of thousands of simulations, kind of like Monte Carlo, right? It's probably what they did. And to see if making a one-time Roth conversion makes sense in most tax situations based on their assumptions. Now, Lou and Anna, I'm sure that you counsel clients all the time about, gee whiz, should I do a Roth conversion, before they've retired? Typically, how do those conversations go? Lou, you first.
Sure. So typically we'll look at clients' income level if they're still working, and then kind of look what tax bracket they're currently in, and explore the possibility of doing a Roth conversion if it makes sense for them. Unless they're in a super high tax bracket that may reduce in the future in retirement, may not make sense. But typically it does make sense to do that conversion relatively early.
And what kind of scenarios do you run? It's like a one-time conversion, or you piece it out, or what are the analytics and factors that go into the council?
Yeah, so obviously we're looking at their current income, their expected, projected income in retirement. And typically we are looking yearly to see how much we can convert, keep them in a certain tax bracket that they're comfortable with, and try and make the conversions over time less of a tax hit.
Yeah, so I think that really is key. It's, anybody can do a Roth conversion, but the real question is, how much value do you give up? So if you've got, in this example, we'll get back to in a second, $1 million, if you're in a 20% tax bracket, you're starting out with $800,000, right? But if it pushes you to the 40% bracket, you're only starting out with $600,000. So these guys ran their analysis in a lot of different scenarios, and I won't bore you with the technical details, but they started with $1 million and then looked at the value of the portfolio 10 years later. And their findings were, which may be somewhat surprising to some of you, across all tax regimens investigated, the one-time Roth conversion yields the best final balance. Using this method, again, starting out with $1 million pre-tax, an investor would yield an average difference in the final balances 10 years after conversion of $110,000 over the 10-year period. Gee whiz, that's 11%, right? That's pretty darn good. And the second most cost-effective method was doing an equal installment method, maybe taking a fourth of it for 4 years and so forth. And that's really, and the reason we bring this up to you today is to get you thinking. Obviously, the back of the envelope rules of thumb, are only take you so far. You really got to dig in and crunch the numbers. And we've actually developed at Camarda a fairly sophisticated process, which we actually have trademarked with the patent office, called Rothalize, that really gets into the nitty gritty. So some of the shortcomings may be, gee whiz, if you converted the whole thing this year and you're in a 25% tax bracket and you dump another $1 million on top of that this year, what's going to happen?
You're going to pay a lot more taxes.
Yeah, you're going to be at the highest tax bracket that year. And as Anna suggested, maybe we piece it out a little bit each year. So you really want to do the math, folks, to look at optimizing the lowest bracket, something I call tax arbitrage, but really just basically means trying to model your factors and variables so you're able to enjoy the lowest possible tax bracket when you make that decision. So that's something that those of you that aren't Camarda clients, hopefully your CPA or advisor, is adept enough to go through. And if you look, I think we've run a number of webinars, I think, on this and seminars if your advisors need to bone up. If you are Camarda clients, so we have this process at which Anna and Lou and their teams are trained to go ahead and optimize and minimize. And the objective is, believe it or not, it is possible to get as close to a zero tax bracket as possible, which obviously is panacea, right? You're taking what would have been taxable and you're shooting through the hole when you have the opportunity and getting out, scot-free, which is just great and happens more frequently, you might think. So one final critique on this article is, if we're looking at folks doing the conversions before retirement, presumably they're still working and have additional earned income that the Roth conversion income is going to stack on top of to drive you faster to higher brackets. But in any event, it's hopefully you think about this. It really, really is great if you can find a way to convert to Roths and avoid paying tax, or higher tax on a traditional. You just drive a lot more family wealth. Any concluding comments here, Lou or Anna?
Yeah, just for me, everyone's situation is different. So, talk to your financial advisor. If you don't have one, reach out to us or someone who you trust and have these conversations, because like I said, everyone's situation is a little bit different, and we have to do specific analysis for your situation to exactly know and tell you what the best case scenario would be for you, whether it's now or to delay it, do it later. Everyone's
a little bit along the way, or a little bit after a certain date. Anna, any parting comments?
Yeah, I'd say our clients that we work with that are in the middle of doing a conversion strategy like this, it's a discussion that we're constantly having. Is the market down a little bit? Maybe that's the time to do a little bit more. It's not just a blanket, one and done. You want to work with an advisor that can make a robust plan that's flexible.
Well said. Well, thank you so much, Super CFPs. Until next time, thank you all for watching. This is your Wealth Doctor, Jeff Camarda. We'll see you next time.